What if the most important buyer of United States debt is no longer overseas, but inside the system itself? What if the world did not stop trusting treasuries overnight, but quietly stopped depending on them? And what if the real risk is not collapse, but the moment when the system has to support itself without pretending that nothing has changed? Because when foreign central banks step back in silence, markets do not panic. They adapt. And adaptation is where the real story begins. What looks like a sudden market headline is almost never sudden. In global finance, the most important moves are the ones that happen quietly, spread across months and quarters, buried inside balance sheets that only a handful of people read carefully. The reduction of foreign central bank exposure to United States Treasury securities belongs exactly to this category. There was no emergency meeting, no dramatic press conference, no single trading day where yields exploded and markets froze. Instead, the shift appeared gradually, hidden inside reserve composition reports, custodial data, and subtle changes in auction participation. To the untrained eye, nothing happened. To anyone who understands how monetary systems really function, something profound has been unfolding in slow motion. For decades, United States Treasuries were not merely bonds, they were the backbone of the global financial system. They functioned simultaneously as a reserve asset, a collateral instrument, a liquidity anchor, and a geopolitical signal of alignment. When a central bank accumulated treasuries, it was not making a bet on yield. It was buying access to the deepest capital market on earth and anchoring its currency to the center of the global dollar system. This relationship created an illusion of permanence. Because it lasted so long, markets began to treat foreign demand for treasuries as a law of nature rather than a strategic choice. That assumption has quietly broken. The first signal did not come from yields. It came from custody data. Holdings of United States government securities held at major custodians on behalf of foreign official institutions began to stagnate, then slowly decline. The change was not violent, it was measured. Maturities were allowed to roll off without full reinvestment. New issuance was absorbed elsewhere. The pattern was subtle enough that it could be dismissed as noise, seasonal adjustment, or technical rebalancing. But the persistence of the trend removed any doubt. This was not tactical, it was structural. Publicly, officials avoided the word selling. Selling implies panic. Selling implies disagreement. Instead, the language shifted toward neutral phrases such as diversification, reserve optimization, and balance sheet resilience. These phrases are deliberately boring. They are designed not to move markets. But behind them lies a strategic recalibration, driven by incentives that have fundamentally changed. One of the most misunderstood aspects of this shift is scale. Even small percentage changes in reserve allocation represent enormous flows. Global foreign exchange reserves are measured in the tens of trillions of dollars. A reallocation of a few percentage points away from treasuries does not require aggressive selling to have systemic consequences. It simply requires time. And time is precisely what central banks have. This is why markets fail to react. Traders are conditioned to respond to shocks, not to trends. Algorithms are designed to detect volatility, not intent. A central bank that allows bonds to mature quietly without reinvestment does not create headlines. Yet from a systems perspective, this behavior is more dangerous than a one-day crash, because it signals a loss of strategic commitment rather than temporary fear. The logic behind this move cannot be understood without examining how the role of treasuries has changed since the global tightening cycle began. Rising interest rates did not simply increase yields. They fundamentally altered the risk profile of existing bond portfolios. Central banks that accumulated treasuries during the era of near-zero rates now hold assets with significant unrealized losses. While these institutions are not mark-to-market constrained in the same way as private investors, losses still matter politically, institutionally, and psychologically. They affect credibility. They affect confidence. They affect the internal calculus of risk committees that exist precisely to avoid explaining losses to governments and populations. At the same time, currency dynamics became more volatile. Holding treasuries is not just a bet on American credit. It is a bet on the dollar. As exchange rates began to swing more aggressively, the currency risk embedded in reserve portfolios increased. A yield that looks attractive in nominal terms can be erased by exchange rate movement. For a central bank, that trade-off is rarely acceptable. Stability always dominates return. Yet interest rates and currency risk alone do not explain the depth of the shift. The real catalyst lies deeper. in the transformation of financial assets from neutral instruments into tools of state power. When reserves can be frozen, access restricted, and settlement channels politicized, the definition of a safe asset changes. Safety is no longer determined only by credit quality and liquidity. It is determined by legal reach and political alignment. This realization spread quietly through monetary authorities across the world. It did not require public statements. It required only observation. Assets once considered untouchable were shown to be conditional. The message was absorbed instantly. The response, however, was calibrated, cautious, and deliberately slow. No central bank wanted to be first, but none wanted to be last. Reports from institutions such as the International Monetary Fund began to show subtle but consistent shifts in reserve composition. The dollar remained dominant, but its share stopped growing. In some cases, it declined. Gold allocations increased. Regional currency arrangements expanded. Bilateral settlement frameworks multiplied. None of these changes threatened the system individually. Together, they signaled a change in philosophy. What makes this moment particularly important is that it coincides with a dramatic expansion in United States fiscal issuance. The supply of treasuries has been rising rapidly, driven by structural deficits rather than cyclical stimulus. In the past, foreign demand absorbed a significant portion of this issuance automatically. That automaticity is now gone. Demand must be cultivated, not assumed. The response from the Federal Reserve has been to emphasize market depth, resilience, and the enduring role of treasuries as the world's benchmark asset. These statements are not wrong. The treasury market remains the largest and most liquid bond market in existence. But liquidity alone does not guarantee strategic loyalty. Central banks do not think in terms of benchmarks. They think in terms of sovereignty. This is the core misunderstanding in public discourse. Commentators ask why central banks would reduce exposure to treasuries when yields are higher than they have been in years. The question itself reveals a private market mindset. Central banks are not optimizing portfolios. They are managing national balance sheets under conditions of uncertainty, political risk, and systemic fragility. Yield is secondary. Control is primary. The most telling aspect of this transition is its invisibility. There is no dramatic sell-off to point to. No single data release captures it fully. It lives in the slow erosion of assumptions that once held the system together. It is visible only when one stops looking for panic and starts looking for intent. Intent matters more than flow. A market can absorb enormous selling if participants believe demand will return. It cannot function indefinitely if long-term holders quietly decide that their commitment is conditional. This is why the current moment deserves attention, not because it signals collapse, but because it signals a redefinition of what safety means in a fragmented world. The global financial system is not breaking, it is adapting, and adaptation always begins in silence. For years, the relationship between interest rates and safety felt intuitive, almost mechanical. Higher yields meant higher compensation. Higher compensation meant stronger demand. When rates were near zero, investors complained about distortion. When rates finally rose, the assumption was simple: capital would rush back. That logic works in textbooks and trading desks. It breaks down completely inside a central bank. The moment yields began to rise meaningfully, something counterintuitive happened. Instead of attracting long-term official buyers, higher rates exposed a structural weakness that had been hidden for more than a decade. The global system had become addicted to low volatility, stable exchange rates, and predictable monetary policy. When that environment disappeared, the very instruments that once represented safety began to behave like sources of instability. The first crack appeared through valuation. Central banks do not trade frequently, but they do monitor the market value of their assets. When rates rise sharply, the price of existing bonds falls. This is not a theoretical issue. It translates into visible balance sheet deterioration. Even institutions that do not operate under mark-to-market rules must explain losses internally and politically. A reserve portfolio showing persistent valuation decline creates pressure, not confidence. It forces uncomfortable conversations between monetary authorities and fiscal leadership. Safety, in this context, is not about default risk. It is about explainability. This problem intensified because the rate increases were not gradual. They were abrupt by historical standards. Years of suppressed volatility were replaced by sudden repricing across the entire yield curve. Bonds issued during the era of ultra-low rates became anchors dragging down portfolio performance. For private investors, this was painful. For central banks, it was destabilizing. Reserves are supposed to dampen shocks, not amplify them. At the same time, currency volatility surged. A treasury yield is meaningless without its currency context. A central bank that earns yield in dollars but faces depreciation pressure at home may still lose purchasing power in domestic terms. During periods of aggressive tightening, exchange rates can move faster than bond income accumulates. This asymmetry matters deeply to institutions whose mandate is stability. Yield volatility plus currency volatility equals uncertainty. Uncertainty is the opposite of safety. The global tightening cycle also introduced a new form of risk that is rarely discussed outside professional circles: reinvestment uncertainty. When rates are volatile, the timing of maturities becomes critical. Rolling over maturing treasuries no longer guarantees a stable income profile. It exposes the holder to future policy decisions made elsewhere. A central bank holding large amounts of foreign debt becomes implicitly dependent on another country's monetary path. That dependency is tolerable when policy is predictable. It becomes dangerous when policy is reactive. This is where the role of the Federal Reserve becomes central to the story. The Federal Reserve's shift from accommodative guidance to aggressive inflation control changed expectations globally. Forward guidance lost credibility as inflation surprised to the upside. Rate projections were revised repeatedly. From the perspective of foreign monetary authorities, this was not just a domestic adjustment. It was a reminder that control over their reserve assets ultimately rested outside their borders. Another overlooked factor is collateral behavior. Treasuries function as the primary collateral asset in global financial markets. During periods of stable rates, this role reinforces safety. During periods of rapid repricing, collateral values fluctuate, margin requirements adjust, and liquidity becomes conditional. A reserve asset that can trigger margin stress under extreme conditions is no longer purely defensive. It becomes entangled in the same dynamics it is supposed to protect against. Global news over the past cycles reinforced these concerns. Banking stress episodes highlighted how quickly interest rate risk can migrate from balance sheets into systemic issues. Institutions that appeared well capitalized on paper struggled when asset values moved faster than expected. Central banks observed these developments closely. They saw how duration risk, once considered negligible, could destabilize even sophisticated systems. The lesson was clear. Long-duration assets are not neutral in a volatile rate environment. What changed fundamentally is that higher yields stopped being a free reward. They became compensation for instability. This distinction is subtle but crucial. When yields rise because growth is strong and inflation is controlled, bonds become attractive. When yields rise because inflation credibility is questioned and policy must overcorrect, bonds lose their defensive character. The current environment belongs to the second category. This shift also altered the hierarchy of risk inside reserve management frameworks. For decades, credit risk dominated analysis. United States Treasuries were considered free of it. Today, interest rate risk and political risk compete for attention. Neither can be diversified away easily. Both are correlated with global stress. That correlation undermines the foundational logic of reserves. The result is a quiet reassessment. Central banks did not suddenly decide that treasuries are unsafe in an absolute sense. They concluded that treasuries are no longer uniquely safe under all conditions. That distinction changes everything. Once an asset loses its unconditional status, allocation becomes tactical rather than automatic. This explains why higher yields failed to reverse the trend. They addressed the wrong problem. Central banks were not demanding more return. They were demanding more certainty. And certainty cannot be manufactured through yield alone. What emerges from this environment is a paradox. The instruments designed to anchor the system now reflect its fragility. Rising rates were supposed to restore normality. Instead, they revealed how abnormal the previous equilibrium had become. The adjustment is not complete. It is still unfolding, quietly, through policy decisions that never make headlines. The second half of this transformation unfolds not through market prices, but through behavior. Once yields stopped signaling safety, central banks began to re-examine assumptions that had gone unquestioned for decades. The most important of these assumptions was that volatility could be tolerated as long as default risk remained negligible. That belief belonged to an era where monetary credibility was stable and policy frameworks were predictable. In the current environment, volatility itself has become a strategic liability. Interest rate volatility does more than distort valuations. It reshapes planning horizons. Central banks manage reserves to ensure continuity under stress, not to maximize performance in benign conditions. When yields swing sharply, planning becomes probabilistic rather than deterministic. A reserve manager must suddenly model scenarios where the same asset behaves differently depending on policy decisions made thousands of miles away. This undermines the psychological function of reserves, as well as their financial one. Another underappreciated shift involves signaling. Reserve composition sends messages to markets, governments, and domestic audiences. Holding large quantities of foreign sovereign debt implicitly endorses the issuer's policy framework. When that framework becomes unpredictable, endorsement turns into exposure. Reducing exposure quietly allows central banks to limit reputational risk without provoking market reaction. Silence becomes a tool. The tightening cycle also revealed asymmetries in how different economies experience higher rates. For the issuing country, higher rates attract capital and support the currency. For reserve holders, higher rates can weaken domestic growth, pressure exchange rates, and force defensive interventions. In that context, holding the debt of the tightening country becomes counter-cyclical to domestic stability goals. This contradiction forces a reassessment of what alignment truly means. Global financial news reinforced these concerns. Sovereign debt markets around the world experienced stress as borrowing costs rose. Fiscal sustainability debates returned to the foreground. Political negotiations over budgets and debt ceilings introduced uncertainty into what was once considered a purely technical market. Even without questioning repayment, the noise surrounding issuance increased perceived risk. Safety is not only about outcomes, it is about the absence of doubt. The role of international institutions further clarified the shift. Data compiled by the International Monetary Fund showed that reserve diversification was accelerating in regions previously considered firmly anchored to the dollar system. This was not ideological, it was pragmatic. Countries with volatile capital flows and exposure to external shocks prioritize assets that reduce dependency rather than optimize yield. The message embedded in the data was subtle but consistent. Resilience was being redefined. Higher yields also failed to address a critical mismatch between assets and liabilities. Many central banks issue domestic liabilities with short duration while holding long duration foreign assets. When rates rise rapidly, this mismatch becomes costly. The longer the duration of reserves, the greater the sensitivity to policy shocks. Shortening duration reduces yield but increases flexibility. In an uncertain environment, flexibility wins. As this logic spread, the old narrative collapsed. Treasuries were no longer viewed as the default destination for excess reserves. They became one option among several, each evaluated through a new lens. Liquidity remained important, but it was no longer sufficient. Legal certainty, political neutrality, and controllability gained weight. Assets that failed these tests were not abandoned outright, but their privileged status eroded. What makes this transition difficult to detect is that it does not manifest as confrontation. There is no declaration against treasuries, no coordinated action, no alternative unveiled as a replacement. Instead, there is a gradual dilution of dependence. Maturities are shortened, reinvestment ratios decline, incremental allocations shift elsewhere. Each decision is defensible in isolation. Together, they represent a strategic pivot. This is why the question of yield misses the point entirely. Yield belongs to a world where the primary risk is opportunity cost. The current world is defined by systemic risk. In such an environment, an asset that offers higher income but increases vulnerability is not attractive. It is dangerous. The deeper implication is that the global system has entered a phase where trust is conditional and diversification is defensive. Higher interest rates did not restore the old order. They exposed its fragility. Central banks responded not with panic, but with prudence. The adjustment is rational, measured, and ongoing. This shift does not announce itself through crises. It reveals itself through silence, patience, and a steady refusal to treat any asset as untouchable. That is the real meaning behind the quiet recalibration of reserve portfolios. It is not about chasing returns. It is about surviving uncertainty. The third transformation did not originate in markets, balance sheets, or yield curves. It originated in law, diplomacy, and power. For most of the modern financial era, money attempted to present itself as neutral. Capital flowed across borders under the assumption that finance existed above politics, insulated by contracts, institutions, and precedent. This assumption was never fully true, but it was stable enough to function. What changed in recent years is not the existence of political influence, but its visibility and explicitness. When reserves were frozen, access restricted, and settlement channels severed, the global monetary system crossed a psychological threshold. For the first time in decades, central banks were forced to confront a reality that had previously been theoretical, that reserve assets are only as safe as the political relationship behind them. This realization did not require ideological alignment or opposition. It required observation. Once the precedent existed, every reserve manager had to assume it could apply elsewhere under different circumstances. The impact of this shift cannot be overstated. Central banks do not operate on trust alone. They operate on expectations of continuity. When continuity becomes conditional, risk frameworks must be rewritten. An asset that can be rendered unusable by executive decision, court order, or geopolitical escalation carries a form of risk that cannot be priced through yield or diversified through allocation. It is binary. Either access exists or it does not. The dollar's role as the dominant reserve currency was built not only on economic skill, but on the perception of legal neutrality. United States financial markets were viewed as rule-bound, predictable, and separate from foreign policy objectives. That perception allowed Treasuries to function as global collateral without constant political calculation. Once financial infrastructure became explicitly linked to strategic objectives, that separation weakened. This did not mean an immediate rejection of the dollar system. It meant a reassessment of exposure. Central banks asked a new question, one that had rarely been asked before. Under what conditions could these assets become inaccessible? The answer did not need to be probable. It only needed to be possible. In risk management, possibility is enough. Global news cycles reinforced this awareness. Sanctions regimes expanded in scope and sophistication. Payment systems were no longer merely technical utilities. They became instruments of enforcement. Clearing, custody, and settlement acquired strategic importance. From a reserve management perspective, this altered the hierarchy of risk. Legal and political exposure moved ahead of market volatility. An asset immune to default but vulnerable to restriction no longer fit the classical definition of a reserve. This shift also reframed the concept of alignment. Previously, holding treasuries was interpreted as a sign of integration into the global financial order. It was mutually beneficial. Capital flowed in, liquidity flowed out. Today, alignment implies vulnerability. The more integrated a system is, the more exposed it becomes to external decisions. For countries seeking to preserve policy autonomy, this trade-off became increasingly uncomfortable. The reaction was not coordinated, but it was consistent. Central banks began exploring alternatives that reduced dependency on any single jurisdiction. This did not mean abandoning the dollar. It meant reducing its exclusivity. Incremental diversification was sufficient. The objective was optionality. Optionality is the currency of sovereignty. Institutions, such as the International Monetary Fund, documented these shifts through aggregate data. The reports did not frame them as geopolitical reactions. They framed them as portfolio adjustments. This framing was deliberate. It allowed the transition to occur without triggering market instability, but the underlying cause was understood by those reading between the lines. Another critical element in this chapter is credibility. Monetary credibility is not static. It is accumulated slowly and lost suddenly. When reserve assets are used as instruments of pressure, credibility becomes conditional. Conditional credibility forces diversification by default. No central bank can justify holding the majority of its reserves in instruments that carry non-financial conditions, regardless of how remote those conditions may seem. The response from the issuing authorities emphasized the enduring strength of institutions and the rule of law. These arguments are valid, but they address the past more than the future. The issue for reserve managers is not whether institutions are strong today. It is whether they can be relied upon under extreme scenarios. The distinction is subtle but decisive. The Federal Reserve continued to stress the technical integrity of markets, the depth of liquidity, and the absence of capital controls. All of this remains true. Yet none of it answers the core concern. Liquidity does not help if access is restricted. Depth does not matter if settlement is blocked. Safety is no longer defined solely by market mechanics. What emerged instead is a layered approach to reserves. Treasuries remain important, but they are no longer treated as inviolable. Exposure is calibrated, duration is adjusted, concentration is avoided. The objective is not disengagement, but insulation. Central banks are not exiting the system. They are hedging against its politicization. This chapter marks a fundamental shift in how power is perceived in finance. Money is no longer just a medium of exchange or store of value. It is an instrument of influence. Once that reality becomes explicit, neutrality becomes an illusion. Reserve management adapts accordingly. This adjustment is still in its early stages. It unfolds through legal reviews, contingency planning, and internal memoranda that never reach the public. There are no dramatic statements, because none are required. The logic is self-evident to those responsible for safeguarding national balance sheets. The system continues to function. Markets remain liquid, auctions clear, headlines remain calm. But beneath that calm lies a structural change in how trust is allocated. And when trust becomes conditional, diversification is no longer a choice. It becomes a necessity. This is only the first half of how geopolitics reshaped reserve logic. The second half of this shift unfolds in the operational details that rarely reach public discussion. Once reserve assets are understood as potentially conditional, central banks must redesign not only portfolios, but procedures. This is where geopolitics stops being abstract and becomes mechanical. Access risk forces institutions to think in terms of pathways rather than promises. It is no longer enough to know that an asset is legally owned. What matters is whether it can be mobilized under stress, transferred across jurisdictions, or converted into liquidity without external permission. This concern reshaped how settlement infrastructure is evaluated. Payment systems, clearinghouses, correspondent banking networks, and custodial arrangements move from the background to the center of reserve strategy. Assets held within a single legal ecosystem concentrate not only financial risk, but jurisdictional exposure. Even if that ecosystem is stable, the concentration itself becomes the vulnerability. The solution is not dramatic withdrawal, but redundancy. Redundancy reduces dependence. Dependence amplifies leverage. Central banks began mapping worst-case scenarios that would have seemed implausible in earlier decades. These exercises did not assume hostility. They assumed uncertainty. What if access is delayed? What if transactions are scrutinized? What if legal interpretation shifts during a crisis? None of these questions require confrontation to become relevant. They require only precedent. Once precedent exists, the scenario must be modeled. This logic explains why the response was gradual. Sudden reallocations would signal fear and provoke reaction. Gradual diversification signals prudence. It allows institutions to protect themselves while maintaining outward stability. In geopolitical finance, stability is not the absence of change. It is the careful management of perception. The implications extend beyond treasuries themselves. The concept of a global risk-free asset begins to fragment. Risk-free no longer means immune to default. It means resilient across political regimes, legal frameworks, and crisis conditions. Very few assets meet this definition. None meet it perfectly. The result is not replacement, but layering. Different assets protect against different risks. No single instrument dominates all scenarios. Global developments reinforced this mindset. Trade relationships became more regional. Supply chains were reassessed. Strategic autonomy entered policy language across continents. Finance followed the same path as industry. Just as governments sought to reduce reliance on single suppliers, central banks sought to reduce reliance on single jurisdictions. The symmetry is not accidental. Money is infrastructure. Infrastructure is power. This shift also altered the internal politics of reserve management. Decisions that were once technical became strategic. Committees expanded. Legal departments gained influence. Risk assessments incorporated geopolitical variables previously considered external. Reserve management stopped being a purely monetary function. It became an extension of national security policy, even when framed in neutral language. International data reflected this evolution subtly but consistently. Reports tracking reserve composition showed increased dispersion. No alternative currency captured the role once held exclusively by the dollar. Instead, shares redistributed incrementally. Gold gained prominence not because it yields, but because it sits outside legal systems. Regional currencies gained relevance not because they are superior, but because they reduce concentration. The pattern matters more than the destination. The role of the International Monetary Fund in documenting these changes is revealing. Its reports emphasize continuity and gradualism. They avoid alarmist interpretation. Yet the underlying data shows a world where reserve behavior is no longer driven solely by economic efficiency. It is driven by strategic optionality. Optionality is the ability to choose under pressure. That ability has become scarce. Issuing authorities responded by reaffirming openness, market depth, and institutional strength. These reassurances are necessary, but they no longer close the argument. The concern is not about intent today, it is about capacity tomorrow. Even the most stable system can be repurposed under extreme conditions. Once that is acknowledged, diversification becomes rational rather than ideological. The Federal Reserve continues to operate within a mandate focused on domestic stability. This is appropriate and expected. But from the perspective of foreign reserve holders, domestic mandates elsewhere can have global consequences. When domestic priorities override international spillovers, reserve assets inherit that tension. This is not a critique, it is an observation. Systems evolve according to incentives, not assurances. What emerges is a quieter form of fragmentation, not the collapse of a system, but the dilution of its universality. The dollar remains central. Treasuries remain liquid, but centrality is no longer exclusivity. Reserve managers plan for a world where access must be preserved under multiple scenarios. That planning naturally reduces concentration. This transition does not end with a new equilibrium. It creates a permanent bias toward diversification. Once neutrality is questioned, it cannot be fully restored through rhetoric. Trust, once made conditional, remains conditional. The system adapts by spreading exposure rather than eliminating it. The deeper meaning of this chapter is not that finance has become political. Finance was always political. The difference is that politics is now openly embedded in financial plumbing. When that happens, reserve management becomes an exercise in risk containment rather than yield optimization or tradition. The quiet move away from unquestioned dependence is not an act of defiance. It is an act of self-preservation. And self-preservation, when practiced by institutions that think in decades rather than quarters, reshapes the system more profoundly than any crisis ever could. When the question shifted from why treasuries were being reduced to what was being accumulated instead, the answer disappointed anyone looking for a clean replacement. There was no single asset stepping into the role once occupied by United States government debt. No new anchor emerged. Instead, what appeared was something far more revealing: fragmentation by design. Central banks were not searching for a new center, they were deliberately avoiding one. The first visible beneficiary of this shift was gold. Not because it had changed, but because everything else had. Gold did not suddenly become more productive, more liquid, or more efficient. It became politically inert. It carries no issuer risk, no jurisdictional dependency, no settlement gatekeeper. It cannot be frozen through court order, blocked through payment systems, or rendered inaccessible through sanctions. For reserve managers recalibrating their definition of safety, these characteristics mattered more than yield. What makes the renewed accumulation of gold particularly important is its context. Gold allocations increased not during inflationary panic among households, but during periods of strategic reassessment by institutions. Central banks, with vastly different political systems, economic structures, and foreign policy alignments, all increased exposure. This convergence revealed that the motivation was systemic rather than ideological. Gold was not a protest asset. It was an insurance asset. At the same time, reserve managers understood gold's limitations. It is not a transactional asset. It does not generate income. It is costly to store and difficult to mobilize quickly in modern financial markets. This meant gold could supplement reserves, but not replace liquid sovereign debt. The implication was clear. The future of reserves would be plural, not singular. Beyond gold, central banks explored regional currencies and bilateral arrangements. This did not imply confidence that these currencies could rival the dollar globally. It implied something more modest and more strategic. Regional currencies reduce exposure concentration. They align reserves with trade flows. They allow settlements to occur outside dominant systems when necessary. Even small allocations can materially improve flexibility under stress. This logic was visible in reserve composition data aggregated by the International Monetary Fund. Over time, the share of non-traditional reserve currencies increased gradually. No single currency gained dominance. Instead, the distribution widened. This widening was the signal. It showed that the objective was not substitution, but dispersion. Another important development involved the shortening of duration. Central banks reduced exposure to long-dated securities in favor of shorter maturity instruments. This reduced sensitivity to interest rate shocks and allowed faster repositioning. Short-duration assets sacrifice yield, but they preserve optionality. In an environment defined by policy volatility, optionality is more valuable than income. Liquidity management practices evolved alongside portfolio composition. Central banks increased emphasis on assets that could be mobilized across multiple venues. Custodial diversification became as important as asset diversification. Holdings were spread across jurisdictions, institutions, and settlement systems. This approach reduced the risk that access to reserves could be impaired by a single point of failure. World news reinforced the rationale behind these adjustments. Episodes of market stress revealed how quickly liquidity can become conditional. Assets that appeared liquid under normal conditions proved difficult to move when volatility spiked. Central banks observed how market depth depends on confidence, not just size. Liquidity is a behavior, not a property. The shift also extended to reserve accounting frameworks. Stress testing scenarios became more complex. Instead of modeling only market shocks, central banks incorporated legal and geopolitical contingencies. What happens if settlement is delayed? What happens if counterparties withdraw? What happens if access is restricted temporarily? These questions reshaped internal risk assessments. An often overlooked aspect of this transition is the role of domestic politics. Reserve losses, even unrealized ones, carry political consequences. Governments scrutinize central bank decisions more closely during volatile periods. Diversifying into assets perceived as safer politically can reduce domestic pressure. Gold, for example, is intuitively understood by the public. Its symbolism matters. Importantly, none of these shifts required abandoning the dollar system. They required only acknowledging its conditional nature. The dollar remains central to trade, finance, and reserves. But central banks no longer treat centrality as immunity. They plan for a world where even dominant systems can be stressed. Issuing authorities responded by highlighting continuity. They emphasized that Treasuries remain the most liquid and reliable asset available. This is true, but liquidity alone does not address concentration risk. Reliability in normal times does not guarantee accessibility in extreme ones. Central banks are paid to think about extremes. What emerged is a reserve architecture that looks inefficient by traditional standards. It sacrifices yield, it increases complexity, it reduces elegance, but it increases resilience. And resilience is the currency of uncertainty. This is the first half of a deeper transformation. The move away from treasuries did not create a new anchor. It dissolved the idea that an anchor is desirable. Central banks are not replacing one pillar with another. They are spreading weight across many supports, accepting that no single structure can bear the full load anymore. The era of a single, unquestioned reserve asset is not ending in collapse. It is ending in quiet dilution. The second half of this evolution becomes visible when reserve diversification is viewed not as asset selection, but as system design. Central banks stopped asking which instrument offers the best characteristics and began asking which combination minimizes dependence. This change in framing explains why the emerging reserve landscape appears inefficient to traditional investors. Efficiency was never the goal. Survivability was. One of the clearest expressions of this mindset is the rise of functional redundancy. Instead of relying on a single asset to perform multiple roles, reserve portfolios increasingly assign different roles to different instruments. Liquidity is separated from neutrality. Yield is separated from sovereignty. Crisis mobilization is separated from long-term storage. Treasuries continue to serve some functions exceptionally well. They simply no longer serve all of them simultaneously. This approach mirrors how critical infrastructure is designed. No modern system relies on a single backup. Redundancy is built not because failure is expected, but because failure is unacceptable. Central banks now treat reserve architecture in the same way. The objective is not optimization under normal conditions. It is continuity under abnormal ones. Gold fits naturally into this logic. It is not expected to be mobilized frequently. It is expected to exist outside the system when the system itself is questioned. Its role is existential rather than transactional. This explains why gold accumulation often coincides with periods of geopolitical reassessment rather than inflation spikes. The signal is not about prices, it is about trust. Regional currencies play a different role. They support trade continuity when global settlement becomes fragmented. They reduce exposure to external policy decisions. They allow local liquidity provision without routing through dominant financial hubs. Their inclusion in reserves reflects realism, not ambition. No reserve manager believes these currencies will replace the dollar globally. They are included because they reduce friction locally. Short duration instruments address yet another dimension of risk. They preserve maneuverability. When uncertainty rises, the ability to reposition matters more than incremental return. Long-duration assets embed assumptions about policy stability over extended horizons. In the current environment, those assumptions are fragile. Reducing duration is a rational response, even if it appears conservative. Operational diversification reinforces these portfolio choices. Central banks spread custody across multiple jurisdictions. They avoid excessive concentration in any single clearing system. They maintain alternative settlement pathways. These decisions rarely appear in public data, but they shape resilience profoundly. An asset is only as safe as the infrastructure supporting it. Data aggregated by the International Monetary Fund shows that reserve dispersion increased even as overall reserve levels stabilized. This matters. It indicates that diversification was not driven by accumulation alone. It was driven by redistribution. Existing reserves were rethought, not merely expanded. This redistribution also reflects a deeper philosophical shift. Central banks no longer view reserve assets as static stores of value. They view them as dynamic tools that must function under multiple regimes. The old assumption that markets would remain open and neutral under all conditions no longer holds. Once that assumption disappears, design replaces tradition. Issuing authorities continue to emphasize the structural strengths of their markets. The Federal Reserve regularly highlights liquidity, transparency, and institutional depth. These attributes remain unmatched. Yet, from the perspective of diversification, superiority does not eliminate concentration risk. Even the best system can become a single point of failure if relied upon exclusively. The irony of this transition is that it unfolds during a period of relative calm. There is no global financial crisis forcing abrupt change. There is no collapse demanding emergency measures. Instead, central banks are acting preemptively. They are using calm conditions to restructure exposure quietly. This is precisely how institutions behave when they believe future shocks are likely but unpredictable. This behavior also explains why markets misinterpret the signal. Investors search for substitutes and narratives. They ask which asset will replace Treasuries. They expect a new hierarchy. What they fail to see is that hierarchy itself is being questioned. Central banks are not crowning a successor. They are dissolving the throne. The implications extend beyond reserve management. A system without a single, unquestioned anchor behaves differently under stress. Liquidity fragments, correlations shift, policy coordination becomes harder. At the same time, systemic risk becomes less centralized. Shocks propagate differently. No single market carries the full burden. This does not imply instability by default. It implies adaptation. The global financial system is adjusting to a world where power is more diffuse and trust is conditional. Reserve portfolios are simply reflecting that reality. They are not predicting collapse. They are preparing for complexity. What emerges is a mosaic rather than a pillar. Each piece serves a purpose. None claims universality. This structure lacks elegance, but it gains resilience. It accepts that safety is contextual rather than absolute. The move away from treasuries, when viewed through this lens, is not rejection, it is reclassification. Treasuries remain essential, they are just no longer sacred. Once that mental shift occurs, diversification becomes not a statement, but a necessity. The quiet rebuilding of reserve architecture reveals more about the future than any headline ever could. It shows a system learning to live without absolutes. The final question emerges naturally once the illusion of automatic foreign demand fades. If global central banks are no longer the unquestioned buyers of last resort, who absorbs the growing volume of United States government debt? This is not a theoretical concern. It sits at the center of the modern financial system, quietly shaping policy choices, market behavior, and the future architecture of capital flows. For decades, the answer was simple. Foreign official institutions recycled trade surpluses into treasuries. This arrangement supported the dollar, suppressed yields, and allowed the United States to finance persistent deficits without visible strain. The mechanism was stable precisely because it was impersonal. No single actor needed to decide to support the system. The system supported itself. That mechanism no longer functions automatically. As foreign demand softened, the composition of treasury buyers changed. Domestic institutions moved to the foreground. Commercial banks, pension funds, insurance companies, mutual funds, and households increased their relative share. This shift appears benign at first glance. After all, domestic demand reduces reliance on foreign capital. But the incentives and constraints of domestic buyers differ fundamentally from those of central banks. Central banks buy treasuries to store value and ensure liquidity. They are indifferent to short-term mark-to-market losses. They operate on long horizons. Domestic institutions do not. Banks face regulatory capital requirements. Funds face redemption risk. Insurance companies face duration matching constraints. Households react to headlines and income needs. These differences matter. When domestic buyers dominate, demand becomes price sensitive. Yield levels begin to matter more. Volatility matters more. Policy signaling matters more. The treasury market becomes less of a passive reservoir and more of an active battlefield where expectations collide. This change increases sensitivity to macroshocks, even if headline demand remains strong. The role of the Federal Reserve becomes critical in this environment. The Federal Reserve is not merely a regulator or a policy setter. It is the only institution capable of absorbing supply without regard to price, duration, or political optics. Its balance sheet functions as the system's stabilizer of last resort. This reality introduces a delicate tension. On one hand, the Federal Reserve emphasizes its independence and domestic mandate. On the other, its actions increasingly determine global financial stability. When foreign demand weakens and domestic buyers hesitate, the pressure on the central bank intensifies. Balance sheet expansion becomes less about stimulus and more about market functioning. This shift alters perceptions. When central bank purchases are interpreted as structural rather than temporary, confidence dynamics change. Markets begin to price not only economic fundamentals, but policy inevitability. The boundary between monetary policy and debt management blurs. That boundary was always thin. It is now transparent. At the same time, fiscal dynamics complicate the picture. Deficits are no longer cyclical. They are structural. Aging populations, entitlement spending, defense commitments, and interest costs create a baseline level of issuance that does not decline meaningfully during expansions. This means supply pressure persists regardless of growth conditions. In the past, global demand absorbed this pressure quietly. Today, absorption requires active decisions by domestic actors. These decisions are influenced by yields, inflation expectations, and political narratives. The market becomes more reflexive. Price movements influence policy expectations, which influence price movements in return. Global news cycles amplify this reflexivity. Debt ceiling debates, budget negotiations, and fiscal standoffs introduce episodic uncertainty into what was once considered the safest market in the world. Even when resolutions are reached, the repetition erodes the perception of effortlessness. Safety becomes procedural rather than assumed. International observers notice this shift. Reports from institutions such as the International Monetary Fund increasingly discuss domestic absorption capacity, interest burden sustainability, and the interaction between fiscal and monetary frameworks. The language remains measured. The implications are not. Another consequence of reduced foreign participation is the redistribution of interest payments. When treasuries are held abroad, interest flows out. When they are held domestically, interest circulates within the economy. This can appear positive, but it also concentrates exposure. Domestic financial stability becomes more directly tied to sovereign financing conditions. Banks holding larger quantities of government debt become more sensitive to interest rate movements. Pension funds face valuation swings. Household portfolios become indirectly linked to fiscal outcomes. Sovereign risk does not disappear. It migrates inward. This migration reshapes political incentives. Policymakers become more aware that market instability affects domestic constituencies directly. Pressure to stabilize markets intensifies. This reinforces the expectation of central bank intervention. The feedback loop tightens. None of this implies imminent crisis. The United States retains unmatched advantages: deep markets, institutional credibility, and global integration. But the system now relies on conscious support rather than automatic flows. Conscious support is inherently more fragile. It depends on trust, coordination, and confidence. The first half of this chapter reveals a subtle but profound shift. The question is no longer whether the United States can finance itself. It can. The question is how the burden is distributed and what that distribution implies for future stability. When the buyer base changes, the character of the market changes with it. The center of gravity has begun to move inward. The second half of this chapter confronts the implications of that inward shift and follows its consequences to their logical end. When the center of gravity moves inside the system, stability depends less on global coordination and more on domestic coherence. This is a subtle but decisive change. It alters how stress propagates, how policy is interpreted, and how credibility is maintained. As domestic absorption becomes the primary mechanism, the Treasury market increasingly reflects internal economic conditions rather than external imbalances. Inflation expectations, labor market dynamics, and political narratives begin to matter more than foreign reserve strategies. This makes the market more responsive, but also more volatile. Domestic buyers respond quickly to signals. They adjust allocations, they hedge, they retreat. Central banks abroad rarely behave this way. Their absence removes a stabilizing asymmetry. The implication is not that demand disappears, it is that demand becomes conditional. Conditional demand introduces feedback loops. Rising yields attract buyers until they do not. Falling prices invite intervention until they provoke concern. This reflexivity compresses reaction time. The system still functions, but it requires constant calibration. The role of the Federal Reserve in this environment evolves quietly but profoundly. The Federal Reserve becomes the implicit coordinator between fiscal reality and market tolerance. Its decisions influence not only inflation and employment, but the mechanics of sovereign financing itself. This does not require explicit coordination with fiscal authorities. It emerges naturally when markets expect stabilization under stress. This expectation changes behavior. Investors price in support. Risk premia adjust. Volatility compresses until it does not. When policy credibility is high, this mechanism is stabilizing. When credibility is questioned, it becomes destabilizing. The difference lies not in tools, but in trust. Fiscal policy now operates under tighter constraints. Interest costs rise as issuance expands. Political debates intensify. Each budget cycle carries greater symbolic weight. Even routine negotiations can move markets, because the margin for error appears thinner. This does not mean default risk increases materially. It means perception risk does. The international dimension does not vanish. It transforms. Foreign investors still participate. Global capital still flows. But the system no longer assumes that external demand will smooth domestic imbalances automatically. That assumption belonged to an earlier phase of globalization. The current phase is defined by selective integration and strategic autonomy. Institutions like the International Monetary Fund increasingly frame this reality through the language of sustainability rather than crisis. They emphasize interest burden trajectories, growth differentials, and policy coordination. These are technical terms, but they describe a political economy that has become more self-referential. Another consequence of inward financing is distributional. When domestic entities hold more government debt, changes in fiscal and monetary conditions redistribute wealth internally. Higher rates benefit savers and penalize borrowers. Asset prices react. Political pressure mounts. Monetary policy becomes more exposed to social interpretation. Independence is preserved formally, but contested rhetorically. This environment rewards predictability. Sudden shifts carry higher costs. Communication becomes as important as action. Markets scrutinize language, tone, and sequencing. The margin for misinterpretation narrows. Stability depends not only on outcomes, but on narrative control. The most important insight of this chapter is that none of these dynamics require a breaking point to matter. The system does not need to fail to change. It only needs to adapt. Adaptation reshapes incentives quietly, often invisibly, until behavior looks different even though structures appear the same. Foreign central banks reducing their exposure to treasuries did not cause this transformation. They revealed it. Their actions exposed a system transitioning from automatic external support to managed internal balance. That transition carries risks, but also clarity. It forces explicit choices where implicit assumptions once ruled. The future of the Treasury market will not be defined by a single buyer or a single institution. It will be defined by interaction. Between fiscal ambition and monetary restraint. Between market tolerance and policy signaling. Between domestic priorities and global responsibilities. This is not a story of decline. It is a story of maturation under constraint. The era of effortless financing, supported quietly by the rest of the world, is giving way to an era of conscious management. Conscious management is more demanding. It requires discipline, credibility, and coordination. The final conclusion is deliberately unspectacular. The system is not collapsing. It is becoming more honest. When foreign central banks step back, the mirror turns inward. What remains is a market that reflects domestic reality more directly than ever before. This is not a warning, it is a signal. A signal that the age of automatic trust is over, and the age of conscious support has begun. The system will not break loudly. It will change quietly, one decision at a time. If you want to understand where power is moving, who carries the risk now, and how the global financial order is being rewritten without headlines, stay here. Watch closely, because the most important shifts never announce themselves.